What is options trading? We break down the basics, we tackle the risks, and we share why this strategy may boost your retirement portfolio. Here we go. Welcome to the Forget About Money podcast, where we encourage you to take action today so that you can focus on what matters most to you. Today's guests are Karsten Jeske and Brad Finn. Karsten is known as Big Earn and is widely considered the expert on sequence of returns risk. And Brad is an entrepreneur, financial independence enthusiast, and ultra runner. Welcome, gentlemen.
Thanks for having us.
Hey, David. How are you, bud? Thanks.
Yeah, thank you for being here. Karsten and Brad, you are both experienced options traders, and you're going to share your insights on whether options trading is worth pursuing, focusing on a beginner-friendly explanation, hopefully for my sake. Brad, let's do a quick introductions to options trading. Can you start simply by explaining in simple terms what options trading is and how it works?
To be honest, David, no. I mean, there's simple approaches, but I think I'll just lead with one of the most common misconceptions about options is that it is one particular style of investing. And because it's only, quote, one style, it only fits one person. It only has one risk tolerance. And I really want to start with options it's a vague term, trading options. There are so many different ways to use options inside your portfolio. But with that said, my options trading strategy of choice is to sell options, where I'm using shares that I already own as collateral to collect extra money by trading these options contracts, or I'm using cash to write options and collect money. It's all about collecting premium from my side, the seller. The other side, the buyers, they're looking to use options as a high leveraged vehicle to maybe make some more money as opposed to just owning shares where shares go up by a penny or down by a penny. There's so many other factors which kind of makes options intimidating, which allows that value of that options contract to sometimes go up very quickly and down very quickly as well. The term options trading is very vague. It's like saying, I like sports. There's so many different ways you can look at that particular option and many different ways you can trade it, as you mentioned, depending on your own risk tolerance.
Okay. You said a lot of words even I wasn't so sure I could follow. In extreme layman's term, Karsten, when somebody thinks of options, what's the most basic way someone can participate in options?
Right. So as Brad said, there are many different flavors. And obviously, because for every option buyer, there has to be a seller, or for every option seller, there has to be a buyer, right? So the strategies are obviously very different, right? So it's basically the options market think of that as people with different preferences and intentions get together, and the buyer has certain intentions and preferences, and the seller has. I think Brad and I, we have one thing in common. We like to mostly sell options. So that we have in common. Now, the way we execute that in practice every day is probably going to be very different, which is good. So you have potentially the whole spectrum of different option sellers on this channel. And so as Brad already said, so there are different types of options, different strategies that people pursue with them. And so my explanation to somebody who is a novice in options is that so the buyer of a put option is somebody who wants to insure the downside, right? So it might be because you have a portfolio of stocks and you want to have insurance in case that portfolio drops below a certain point. Think of that almost as homeowners insurance, right? So you have almost a deductible, right? So you might not insure any loss. You might insure a loss beyond a certain percentage target, right? So you might say, yeah, okay, I'm willing to take, say, a 5 or 10% loss in my portfolio, but after that, I want to have insurance against further losses. So almost like insuring some property with a deductible, right? So the drop up to the strike price would be the deductible, and after that, the insurance company covers it for you. Or a call option is something where the buyer of a call option is wildly optimistic about a particular stock, and instead of investing in the stock directly, buys a call option, and the call option might be very far out of the money. So the strike price where you start earning money is far above today's price, and you might be able to scoop up this call option for very little money. So with a very small wager, you may you may lose this wager, and well, then that loss is all you have. But then if the stock price goes above the strike price, that's when you start actually getting anything back. If the stock price has to go above the strike price plus the option premium for you to even break even. Sometimes the price of the option might be very small. So the movement up to the strike plus the premium, after that you start making money. But then you make money 1-for-1, and you might have some fantastic returns beyond that. I mean, we're talking about not percent. We potentially could be talking about hundreds of percents of return on that very small wager. Well, actually, most of the time you lose the wager, and it's almost think of that as a lottery ticket. So think of call option buyers as lottery ticket buyers, and put option buyers as somebody who wants to pursue something like an insurance against losses. And so history has told us that most of the time, buyers of these options will lose money on average. So the person who is desperate to buy insurance is overpaying for this downside insurance, and the person who buys lottery tickets, well, we all know what happens to buyers of lottery tickets. On average, you lose money, even though occasionally there are some fantastic returns and very big prizes involved. But in order to achieve this very big payoff, so you potentially lose money on average. So, which educates me to basically be on the other side of these types of actors in financial markets. And this is why I'm selling options, because on average, I am making more money than I'm losing.
Okay, thank you. I like how you've kind of characterized put options as insurance and call options as lottery tickets. That's or at least the hope for the gain, right? So taking a step back, and I'm going to try to. So I'm very lucky to have you here because y'all were both on this podcast before, and you both expressed during our conversations after or before, or even during, that you were into options. So that's why we're having this conversation now. That's why you're back here. I know very little about options. I know a lot about general money stuff, but not a lot about options. So I'm going to try to define it in a way that makes sense to me. And you can tell me where I might be wrong or where I might be getting at least some of it right.
Awesome.
So traditionally, when you're purchasing stocks, you're actually buying a piece of that company. And that's what we all think of, like, or in mutual funds, you're doing it like via third party, or you can buy individual stocks. That's buying ownership in a company. Whereas the options are you're buying a contract, thinking that you're buying a contract in order to buy a share of that company at a particular price. And you can position yourself in such a way to whether if it goes up, you can make money, or if it goes down, you can make money. Is that correct?
Yeah. I'm going to actually start with a little bit of vocabulary, because there's going to be vocabulary that we're using a lot.
Okay.
And you did say something that's really correct. When we trade on the open market, we are buying shares. When we trade options, we are not trading shares per se. We are trading contracts, which represent 100 shares. And there's two major parts of this contract. There's the strike price and there's the expiration price. And if you think about the words call and put, from the buyer's standpoint, a buyer wants to call away 100 shares. That contract is worth 100 shares. The buyer wants to call away those 100 shares and buy them at a lower price than they currently are. And they make the difference. That's what the strike price is. So say your strike price is $100 and the share price goes up to $120. They are going to make the difference, give or take, just for back of the envelope math. They're going to make that difference by the expiration date that they set. Where on the other side, the put side is I want to put 100 shares into the seller's hands at a price that's not favorable for them. And once again, I'm going to make the difference on that. So what the auction is between the buyers and the sellers is how is that contract price going to change? And the buyer is looking to profit on the one side, and the seller profits if it never makes it there. So if you think about those two people who want that, then the insurance and the lotto is a great example. So you say, okay, I want the insurance. Well, the seller is kind of saying it's never going to go that low. So I don't need to worry about that. But to take that risk, the buyer has to pay them, right? When you buy an option, you have to, or when you buy anything, you have to pay money. Well, who are you paying? You're paying the seller of the option the premium price for that contract. And then we're going to see what the value of that contract is going to do. And it's going to do one of two things, really. It is going to exceed that strike price, and we call that in the money. And now the buyer is in control. Or it is going to stay on the other side of that strike price and be out of the money, and the seller is now going to be in control. And then at expiration, it's worthless. So it's all about managing as the seller. Do we think the buyer is being a little bit risky here? And as the buyer, it's all about managing, am I being too risky, too greedy? And the way that the buyer is risky and greedy is by when they choose their expiration, the further they're going to go out in time and expiration, the more time they have for things to go their way. Which if you want to buy, because I buy too, I like selling, but I also buy. But when I buy, the way that I lower my risk is that I push my expiration way, way out in the future, because what that's going to do is allow time to be on my side. Where the seller, when I sell options, I'm looking for expirations that are really, really near and dear, because I don't want time to help the buyer. I want that to expire worthless. That contract goes void, and I get to keep all the money he paid me to open up the contract. So there's two major things: the expiration, which is going to raise the value of the contract or not, and then the strike price. How close is it right now to the share price? That's when it's going to be the most money. And then we can push it farther away from the current price or bring it really, really close at the money to that price.
Okay. Karsten.
Yeah. So I agree with everything. So
Okay.
we should say, so options are derivatives, right? So derivatives means that these are not the actual underlying. When it takes two to tango, it takes one buyer, one seller, and we actually create an options contract out of nothing and consider that as basically a side bet on the underlying. And by the way, the underlying could be anything. It could be a specific stock. It could be Google, Amazon. It can be the overall index, the S&P 500 index. There are SPX options on that. There are options on ETFs that track the S&P 500 index. Actually, the SPY is the most liquid, probably S&P 500 index fund ETF. And then the options on the SPY are then also quite liquid. There are also options on futures contracts. So futures are already derivatives. And then now you have derivatives on the derivative, which is futures options, which I used to do very early on because they have a little bit lower multiplier. They have only a 50x multiplier, whereas the SPX options have the 100x multiplier. So with bigger account size, now I can do the 100x, obviously. And then there are also options on everything else, that pretty much trades on commodities, any kind of commodities, whether cows, pigs, cattle halves, wheat, corn, oil, gold. There, and then also, so for example, the VIX index, right? That's a volatility index on the S&P 500 that's traded as a futures. And then there are again options on that VIX index. So everything that somehow, somewhere trades can have an options market. And so I personally trade only the SPX index options, but so you have basically an entire ocean of potential underlyings and option contracts to choose from.
Yeah, if I can I'll give you a real world example, which also might help, David. We'll use a very popular stock like Apple. Now, if I want to sell an options contract, a call options contract on Apple, first requirement is I need 100 shares of that. So the barrier to entry on some of these can be pretty high. For example, Apple right now trading for $221. You have a $22,000 position in Apple already just to be able to do this. And I'm going to use those 100 shares as my collateral for this call option. Remember, the buyer who I'm going to buy the contract from wants to call those 100 shares away from me. Those are now mine. And my job is to protect those 100 shares. So what I might do is I say, okay, right now Apple is trading for $221. By Friday, I don't think it is going to be at $225. So I'm going to go onto the options market and I'm going to look for buyers that are trying to buy call options for $225. I see one. I say, great. I'll sell you an options contract right now. You have to give me, the buyer has to give me $225, whatever that number could be. It could be $500. The premiums for the amount and value for that contract changes. So the buyer says, it's going to be more than 225. I'm going to win this bet by Friday. And I say, it's not going to win. Now, during that time between now and Friday, we're going to watch the share price. And if on Friday it's below 225, I keep all the money that he bought that contract from me. That's why we're selling options, to collect that premium from buyers. Now, if the price goes over 225 by Friday, he was right. And he gets all of those shares called away from me and I lose my shares. Now, there's other things that we can do, but that's the very basics of it. The buyer selling, hey, by Friday, the share price is going to be at this strike. And the seller saying, nope. And if the buyer's right, he gets 100 shares at a lower price than they're currently worth, right? Because he made the contract for 225. So if it goes up to 230, he just bought 100 shares for $225. Now he can sell them back to the open market for 230. He just made $500 extra on that contract.
Okay.
Where I wanted to stay low and I want to keep my 100 shares. On the flip side, let's say I did not own any Apple whatsoever, but I thought I think the fair market value of Apple is $200. So as a seller, I'm going to put $20,000 up in collateral and find a buyer that will buy a contract from me for $200. Now, if Apple goes down to 200, I get those shares for $200. If they don't, I keep all of the premium and I rinse and repeat. And I think that's where you're going to see very, very wealthy people that are doing this. They are selling put options because they see the market as very, very overvalued. So they're finding a fair market value price and they are writing puts. When we say writing, that just means selling. They are selling put options at a much lower price than the shares are currently trading for. And then as the price stays high, they just keep collecting premium and keep collecting premium. And like we're dealing with 100 shares at a time. But these big wealthy people that have hundreds and thousands of dollars of shares, they're making hundreds and thousands of dollars just with their cash as collateral against these put options, which is really the beauty. I get to choose all my risk. I either get to choose the strike price that I want to buy the 100 shares at, or I get to choose the strike price that I'm willing to sell my 100 shares and have them called away. So when we sell options, in my opinion, we really, really devalue or de-risk ourselves because we get to choose the terms of the contract that those buyers are going to make against us.
But those terms are still based on what you think will or won't happen.
Correct.
So it's still some level of, nobody has a crystal ball. So based on this factor, that factor, the other factor, or the combination of them, you make a best guess and then put yourself in a position to win at this push-pull exchange.
Yeah, and people will use that as a way to criticize options, but that's true for any investing, right? When you buy 100 shares of Apple, you're not buying them with the hopes that it goes down or the knowledge that it's going to go up, right? We buy with whether it's technical analysis, it's a hunch, our buddy at work told us so, right? We're making all these investments for whatever reasons we are. And it's really just a different way to take on risk in the market.
Yeah, thanks. We talked about put options, call options, strike price, and a couple other terminologies. In my very elementary research, I came across a few more words that I don't know necessarily what they mean. And Karsten, if you can help me, I appreciate it. Covered calls and cash secured puts. What are those?
So those are exactly the two probably most basic strategies that Brad just explained. So covered call is, so you sell a call option on a position you already have.
Okay.
And so you imagine you have 100 shares of Apple. They are worth X dollars. And then normally what you do is you would sell a call option a little bit out of the money. And what the reason why people like this is that, so imagine you're already retired, right? And you have a huge portfolio. And you say, whether Apple goes up another 100 or 200%, I already won the game. I'm already fabulously rich. I don't need to shoot for the moon again. I'm actually willing to sell a little bit of this upside potential, this Apple stock or whatever stock you have in your portfolio. And in exchange for that, I get a little bit of yield in my portfolio. So people would do this as basically supplemental income in retirement. It's almost squeeze a little bit of extra. It's not dividend income, right? It's some additional income out of their portfolio. And Now, you would still participate if there's a market crash, right? It would go down, but then this additional yield from selling call options would cushion that a little bit. So that would be, I think, a legitimate strategy for people who want to de-risk their portfolio a little bit. Now, you still participate on the downside, but you sell a little bit on the upside. So that would be the covered call strategy. And then the cash secured put is, as Brad explained, right? You have the cash in your account, $20,000. You want to buy a stock that's trading at, say, 220, and you think I would be willing to buy it for 200. So I'm selling a put option at 200. If the stock were to fall to below that strike price, then I would get the stock at that price. And so I would then lock in a price of $200, even though the price today is 220. But of course, you would not get it if the stock just keeps rallying from 220 to 230 and so on. But you would have generated a little bit of income, right? Because you sold a put option. And so again, that $20,000 in your account, maybe it's now making only 4.75 or 4.6% interest. But with that put selling strategy, you get a little bit of extra income. And depending on how you structure this and what stock you trade and whether it's the S&P 500 index or a very volatile stock, something like NVIDIA, you could actually make more money from the option selling than what you get as your interest on your money market funds that you might have in your account. So this is again a legitimate strategy for people, say, who have a lot of cash sitting around, want to maybe dip their toes in the market, and they say, well, if the market keeps rallying, well, I still made some extra money. And if the market drops, well, then I buy. Well, I wanted to buy the dip anyways. And this is almost a way to lock myself into that thought. Because there are a lot of people who say that, I have a lot of money sitting around. I want to buy the dip. And then the dip happens. And then they get cold feet. And it's, well, no, it's way too risky. I don't want to invest in the stock market. And then there's this way, a lot of people, they never dare to get into the market. And this might be a way where they almost tie themselves and lock themselves into getting into the market if there's a good buying opportunity. And of course, you hope that it's only a dip and then it recovers again. And it's not the next Great Depression where the market goes down by 80%. So these are the two most basic option trading strategies, which is not what I'm doing, but I'll get into some of the things that I'm doing, and we can do that in a few minutes. But so yeah, I mean, generally speaking, these are the two major basic option trading strategies.
And if I could just follow up with that, like the way I see it too is the word covered just means that I have the shares to cover my position, and the cash secured just means I have the cash, because if you have a margin account, you can sell those put options on margin. Not something I would ever go near. And I'm owning a cash secure put. Like when I sell a put option, I have the cash in my account to cover that option if I have to buy those shares. But there are the option of writing a good old put. And if it were to be assigned, pulling out margin to cover that put. So that's when we say covered call, that just means we're just being a little less risky and we're avoiding margin generally.
Okay. All right. I think I'm following.
Good. We're gonna get you to sell your first options contract you're lucky we're outside market hours, or I'd have you on your computer right now getting ready.
Well, that'd be something. Like, how fast can David lose some money in options?
I've called the covered call strategy a win-win strategy. I really there's some ways if you set it up and you get your terms right, I don't see how you can lose if you do it right. And there's always a loss of like potential capital gains you could have made. But if you write your strike price above your cost basis and you get assigned, you still sold for more than you bought, you win. And if it expires worthless, you collected premium and didn't lose your shares, you also win. So it's only when you really get greedy, that's when you're really going to bring that risk onto the table. But anybody beginning, you always got to think like, we're going to probably sell some options first. And because as you mentioned earlier on, the buyers, there's not a good chance for them. And as somebody that's been buying options for years, I can tell you with 100% certainty that I've made way more money, with maybe the exception of GameStop and AMC, which was a black swan event. I've made way more money selling options than I probably ever will buying them.
Karsten, you talked about this might be a strategy for someone who has a large net worth, someone who has already retired, someone who's already achieved financial independence. And before this episode ends, I would like to talk about how you fit this into your overall portfolio and strategy. But for the listener who maybe has not listened to any other episode and is now listening to this one, I want to make it very clear. These two gentlemen, as well as myself, are very well versed in the much more conservative, simple path to wealth approach that I'm sure we all advocate, even though we're talking about options right now. We advocate taking a conservative approach, investing a high or as much as you practically can save into broad market index funds. So if this is your first inkling of our three faces and talking on a podcast, please understand that we all understand this is a very niche strategy when we're talking about the financial independence audience, as well as the overall investing audience. But having said that, we talked about the retiree who might be looking for some additional income. Who else is this suitable for?
I frankly, if I can start, I think it's suitable for anybody that wants to learn it. And I will completely second you, not putting words in my mouth. I agree with you 100%. 90% of my net worth is in VTI. If you listen to my individual episode with David, that is that. And this really started as a hobby for me. I tend to be somebody that wants to know the most about the market, even for just my general basic investing. And as somebody that just has a mind for learning, options were intimidating. So I wanted to sit down and learn it. But as I've learned it over the last 7 to 10 years, I've realized that there is, just like investing in stocks, we can find a way to have a manageable amount of risk. And depending on what our risk tolerance is, where we are in our investing journey, I don't really think there's anybody necessarily that this would be not for. Buying options, definitely. But selling options with a little bit of education and a little bit of mentorship, I think this really, it could be a strategy for anybody. I am somebody that's not extremely wealthy, financially independent, but I've been selling options since I was working my way towards financial independence with that 10% that we always advocate. You know, if you want to take a little risk with 10% of your net worth, whether it's Bitcoin a couple years, for me, I used it to dabble in options and sell options and learn about them. And now the general conversations that I have with people that I'm mentoring is that, wow, why didn't I find out about this sooner? Or, wow, options were all I heard was the bad. And like I mentioned, the sports analogy earlier, like to say options are bad is to say that you don't like soccer because you don't like ping pong. They're two completely different sports. So we can find a place for everybody inside the options trading community, I think.
Karsten, Brad says he limits his to about 10% of his overall net worth. And that's works for him. Where does options fit into your overall financial strategy?
Right. So let me just explain my evolution. So I've been trading options since 2011, almost exclusively selling options. The only way I would buy an option is I would basically buy back a further out of the money option to hedge the risk from the option that I sold. So basically just a spread trade. Mm-hmm. Otherwise, I would not buy options. So I started with this in 2011, also with a relatively small account. And I think it's good that you start with a small account because you want to find your way around. Because it's actually quite dangerous to do this with a basically full-size account with your entire net worth. And because something goes wrong, and something will go wrong. So my personal experience is that you could expect about every 2 years, something nasty happens. So 2018, February, we had a very nasty volatility blow up. 2020, we had the pandemic. 2022, we had the bear market. 2024, we had August 5, which was a big blow up in volatility on that Monday morning, and some crazy out of left field decision by the Japanese central bank. So every 2 years, you something goes wrong. Oh, and before that, I can go back. 2016, we had the Brexit. 2011, actually, right out of the gate when I started, we had the downgrade in U.S. Treasury bonds. And so sometimes something bad happens. And if you've been doing this with a small account and you have the account that's small enough that if you have losses, that it's not going to wipe you out, and you can basically refill and learn and easier way of into this. I think that's definitely recommended. Even though, I mean, I must say, when I did this with a small account, the amount of time that you spend doing this was not really worth it, right? So if I had been at an hourly job where I didn't get paid overtime, right? I mean, imagine you are somebody who gets paid overtime. You could probably make more money by just working another shift or overtime. But obviously now I'm retired, and I would say that my option trading strategy is one of the bases of my retirement plan. Actually, because we're talking a lot about sequence of return risk. So just to give you an example, I have not felt it necessary to liquidate any of my assets. So I could just purely live off of my option trading income, some dividends from my index fund portfolio. I never had to touch any of my tax deferred accounts. So I don't have to do any Roth ladder or any kind of early withdrawals from my 401k plan. So I could, so right now I'm trading options in my taxable account, and that revenue is enough to pay for almost my entire retirement budget. And then I have a little bit of real estate investment income, make a little bit of money from my blog that covers maybe another 10% of my living expenses. But I mean, I make enough money just from the option trading. And that means that since 2018, when I retired, I didn't have to withdraw a single dollar from my equity portfolio. And well, my equity portfolio is up by more than 100% since 2018, right? So by not touching that, I was able to, have a very relaxed retirement experience, because this is the issue of sequence of return risk. You're liquidating equity positions when the market is down, and the market has been down a few times, right? It's pretty dramatically in 2020, obviously. And I didn't have to touch any of that. And as I was actually trading options in March of 2020, and it was by far my most profitable month, in fact. And so I view this as very nice supplemental income opportunity with very minimal time commitment. And I would not want to miss that. And I'm glad I had this training experience early in 2011 till 2018, when I wasn't really doing this with a very big account, but it was serious money, and I would have missed it if I had lost it.
I may have missed it, but were you doing this in your personal accounts, or were you doing this for your job at the time?
I was doing it in my personal accounts, and I proposed it to do that at my job at that time, and I was told, well, we probably don't want to touch that. We know what you're doing, but it would be too risky for us. So this is what they told me at my job back then.
Okay, Brad, I saw you taking notes.
Always taking notes. I'm always taking notes. I'm trying to figure out, like, oh man, I might be able to retire off of this.
There you go.
No, but I will say this. So I mentioned like 90% of my net worth is in VTI, which is, very, very close to what we mentioned in the SPY. And also with VTI, I can sell covered calls against my VTI shares. And when you put something like this into my Roth IRA, where I am not paying taxes on any of the capital gains that I'm making off of selling options against them. And it's like the best of both worlds for me. And the hard part is trying to really convince people that you can. I tell people on my YouTube channel and in my Discord, and the people that have been around me for years, like, it is not absurd to say that you can probably add 2% a month on the high end and 1% on the low end. So you're adding 12%, to your portfolio returns, really for a very, very minimal time commitment. And the more you learn, especially when you're just trading one thing, like one stock. Like if I had a dividend portfolio and I had all these stocks, I'd have to manage all these things. But when I'm just selling options with VTI, I have one instrument. I know it. It has monthly expirations, so I really don't have to manage it very well. I take very conservative strike prices, things like that. And I plan on using it in the same exact way when I get to a point where, I have a 9 to 5 now, but when I'm not, I'm definitely going to supplement a lot of my income. And I've seen people switch from dividend investing over to this because it's a little less stress in their opinion. And it can be win-win if you manage your time properly. And even though I have a very, very conservative investing strategy with things like VTI and VOO, I'm able to add now in a younger phase of my life. I can take on a little bit more risk by selling these options. Right on with the 2 years, because a couple of years back, I was selling puts, and I was also selling puts on stocks that would maybe get me some views on YouTube and things like that. And things tumble. I'll give you an example. Peloton, I sold pretty much at 50% of the share price. I was selling put options on Peloton, thinking there's no way the share price is going to cut in half in 6 months. Well, 6 months later, they were essentially demarketed, right? They're not even on the market anymore. So you are going to lose from time to time, but with consistency and proper risk management, it definitely, I freaking love it. And I wish more people knew. And very rarely do I get people that take the time to understand it. And then they're like, I wish I never learned that. Where I can give you a laundry list of people, including people in the FI community who don't really want to come out and say they trade options, that are doing this. And it wasn't until I really saw some of the ultra wealthy that were selling put options, as a way to manage large sums of money that wasn't invested in the market because they thought the market was overvalued. And I'm like, if they're doing it, there's probably something to learn here. And I could probably try and figure out, what are the really smart money doing? That's kind of where I want to be.
When I think of someone on their FI journey or financial freedom journey, or just working and investing, building their net worth, growing their net worth, when I hear about a strategy like this, I can't help but think there has to be some kind of rule of thumb or a guideline, not necessarily on the education of learning how to do options, but how much of your portfolio do you need in order to dabble deeper into options so that it doesn't risk your portfolio? Is there like a net worth, that guideline? Like if you have a net worth of 200,000 and it's in VTI ETF, that's a good way to start. Or how could you construct a portfolio as you're building it, with the expectation that if you hit 200,000 and then you decide you may want to get into options, what does that look like? Or am I just thinking about this?
I'll start with that. I think anybody that has 100 shares of a stock should seriously consider learning how to sell call options. Simple as that. If you have 100 shares of a stock, I'm not saying you should sell call, but you should learn why you're not. Okay. And as far as selling put options, if you have a large amount of cash and you are a little bit timid to invest in Apple because you think it's so overvalued and it's trading for 221 and you think it's worth 150, and if I could wave a magic wand and make the share price of Apple $150 tomorrow, you'd say, Brad, I got 15 grand, give me 100 shares. You should probably be selling put options. And it's really, and I mean, it's a hard question to answer what you just said. And I always go back to real estate because that is the bread and butter of the FI community. And it's like their little safety blanket. And there's so much risk that comes around with real estate that so many people in the FI community are willing to sweep under the rug. But when it gets to the risk of options trading, it's just all bad. You're going to lose all your money. You're going to tumble and crumble, and everyone's going to point and say, I told you so. Where from my experience of doing both, I see this as less risky. And you wouldn't tell somebody in real estate, like, you need to have a certain amount of money before you invest in real estate. No, you would say, hey, you need to have this in line. You need to have a certain knowledge. You need to know what your risks are, what your cost is going to be, what your plan is. And then regardless, if you think the numbers work, you're going to buy a piece of real estate. And for me, I think if you are in a position where you already own 100 shares and you have a pretty good grasp of what that 100 shares is and what that company is doing, and you have a little bit of education with money and a pretty good hindsight to what's going on, I think as long as the numbers work, just like in real estate, I think anybody could do it at any time.
I think if people trade options and they blow up their portfolio, or at least the option portfolio, not their entire net worth, I wouldn't necessarily even blame the options. I would blame that they started dabbling in stock picking. And that is the danger, that people think they know the market better, right? I mean, obviously people say, oh yeah, but I only pick the good stocks, or I only pick the stocks that I like. And so the dangers with that is obviously the market doesn't care what you like or what you think is good or bad. The market has already priced in all the information that's available at that time. You will not have any more information. Even if you look into some kind of company reports, these company reports, they have already been screened through a millisecond after they were released with some AI and machine learning programs. So everything that's in that has already been sucked out and priced into the market. So you will not really beat the market by being a stock picker. If you then put together a portfolio with options or without options, the danger is that it's very concentrated in technology, very concentrated in consumer cyclical, something like Starbucks. Oh, I like Starbucks. Well, I also should own Starbucks stock then. So I think that is the real danger. I don't think it's the option trading part that's the danger, because obviously, as we have said earlier, you can do this also with the index ETFs, right? So you can do this option trading with index ETFs or with the index itself. There's a CBOE index, the SPX, and you have options on that. And this is what I do. So in that sense, I am doing, and I just give you my example, I am doing the options trading with my entire taxable account. I have one Interactive Brokers account where I've moved everything I have in my taxable account. So that's, and there's no cash, and there is no individual stocks, and there's not even ETFs. It's actually mostly Fidelity index funds. So I moved them from Fidelity to Interactive Brokers. You can do that in a way in kind. So you don't sell your assets. They move in. So there's no taxable event. So then pretty much everything I own is in there. And I have some fixed income, some bonds, some preferred shares, individual preferred shares, not even the ETFs, because the ETFs really have quite high expense ratios. So this is my entire portfolio. And instead of selling covered calls on something I own, because nothing I own in that portfolio is really optionable. There's no options on my Fidelity index fund. And there's also no options on any of the individual, say, Wells Fargo or Goldman Sachs preferred shares. So I'm kind of stuck. And then also on top of that, I don't want to sell any of my stuff to create cash and then do cash secured puts. So my only option that I have, option, and pardon the pun. So the only way I can sell options is to sell basically naked options. So I can sell put options on the S&P 500 index, and I sell call options on the S&P 500 index. And I do that also, as Brad described. I think the juiciest premium is usually for very short duration options. So I do only overnight. So today is Monday, and I sold the Tuesday options, and they will expire in 24 hours at the next expiration. And then on top of that, I also trade some additional options, usually in the morning, right around the open of the market. I sell puts and calls right at the open, expiring that afternoon. And so it's really only 6.5 hours market exposure. And so these are the puts and calls that I sell, and I do that every day. And it's really only taking me a few minutes at the open. So usually, I'm at the West Coast, so for me, the market opens at 6:30 on a weekday, which is okay. I have to get up. My daughter has to get ready for the school bus. And so I'll be up at 6:30, and I'll do my trades. At 6:32, I'll be done. At 6:40, I'll wake up my daughter, and my wife is up too, so she makes breakfast for the two of us, and that's our morning routine. And then the same thing at about 1 p.m. I do a few trades, potentially a little bit before the close. And then there's one other thing that comes with this is kind of options, not 101, but 501. You can't sell as many options as you want, right? There's certain constraints on how much margin and how much exposure the exchange and your broker will give you. So you have to wait until that margin comes back. You have to wait until your old options expire until you can sell new ones for the next day. So that usually at 1 minute after 1 p.m., my margin comes back. I do a few more trades. And usually I'm done at 1:05 p.m., my time in the West Coast. And so that would be my type of option trading. So I will do the option trading on top of the assets that I already have in that taxable account. And I will do that exclusively on the S&P 500 index. There will be no individual stocks. I don't want to touch individual stocks. I don't think I'm a good stock picker. I think I'm an okay market timer in some way in terms of timing volatility. So I definitely noticed that in the past, if the market gets too calm, I'm getting a little bit nervous. If the market gets really nervous, then I get greedy. So it's kind of that Warren Buffett quote, right? If the market gets greedy, you want to be fearful. If the market is fearful, you want to be greedy. So I use that a little bit. So I might change my exposure a little bit over time. That has worked out so far relatively well. So I'm a little bit of a market timer in that sense, but I don't consider myself a good enough stock picker to do this on individual stocks. That's my strategy.
Can I add to that? Because you said a lot of good things, and I want to just give my 2 cents because I've never really thought about it like that, where it's the stock picking, it's not the option. But I mean, I just gave an example of Peloton a couple of seconds ago, how I got burnt.
Yeah.
And that's exactly what you are talking about. And we trade very different styles as well. But I think back now in hindsight, and I've been thinking about all the times that options did me dirty in the last 7 to 10 years. And it really was always trying to get ahead of a stock like Tattooed Chef and all these things that YouTubers in my whole like YouTube scenario.
Yeah.
But for the last 3 to 5 years, I am also a terrible stock picker, and I hate buying stocks outside. You know, I'm an index fund investor,
right.
But I knew that I wanted to trade options. And also it's part of my side gig on YouTube is talking about options. So I said, you know what, if I am an S&P 500 person, then that's the stocks that I'm going to own. And I literally went down the list of the S&P 500 and I bought Apple 100 shares and then I sold options on those 100 shares and I took all the premium to work into Microsoft. Then I got 100 shares of Microsoft and I just worked my way down. And now the 10 stocks that I sell options with are literally the top 10 stocks inside the S&P 500. And they give me like a nice, beautiful, we get the volatility of Tesla, which is freaking crazy. We had the run of NVIDIA this year, but then I still have those Apple and Microsoft, which I don't feel like I'm a stock picker. I feel like what I did is I took an options portfolio that was the S&P 500 index, but I just used individual stocks. And I'll never go outside of that. But trading every day for me would be hard. I trade monthly options.
I see. Yeah, makes sense.
So my expirations, which are very different, I write an option that's a little bit further out of the money, but it's going to have about a month till expiration.
Yep.
So when I write an option, I really don't need to think about it day to day. I kind of check in on it here and there. I love day trading the markets. So like I always know what's going on with the S&P 500 and the NASDAQ, and that's futures, not options. But so I always kind of have an idea. My time that I use to trade my options, it's got to be less than an hour per month to trade 10 stocks. So that's 10 contracts, open and closed. And I've never gone above the 100 shares. I just use all the premiums. I'm just working my way all the way down the S&P 500. And that's been what works for me with my 9 to 5. If I didn't have my 9 to 5 and I could go on my computer and look at the charts twice a day, that might be something I want to do. But I used to trade weekly options expirations, meaning they would expire on Friday. And even that was just like too much. I would rather spend my time in the woods running around or surfing at the beach. So I said, I'm going to make my expirations for a month. And it's just been fantastic. But I wanted to say thank you for pointing out the fact it's not the option's fault. It is the stock.
Sure.
And I'm here to, tell you every time it's done me dirty, it's always been the stock and it's never been the option.
Right. And I should say, so just the reason why I'm doing the opening and the close is I think the 0 DTE, so 0 days to expiration, so same day and then 1 day to expiration. So I find that the premium, that's the purest vol premium that I can get. So I don't have to worry too much about stock because especially with the S&P 500, a lot can happen in 1 month. When I first started in 2011, I also did monthly. And so you sell a put option on the S&P 500 and you think, there's no way it's going to go down like that. But then something like August 2011 happens. So this is why I kept decreasing the time to expiration. And there's even a mathematical reason for it, right? I want to take as many small independent bets as possible, because then when you average over it, it becomes better behaved from a statistical point of view, right? This is called the central limit theorem in math and statistics. So I think of that as if you're the casino, you want the player to play as long as possible because they're losing money, and it increases the probability of them losing money. And I am usually is also what I notice is that if there is some kind of a volatility event, it builds, but it doesn't come from, even if it comes out of left field, like the pandemic, it still builds up, right? There were some crazy trading days in March of 2020 where the market moved by plus minus 12% in 1 day. At that time, I was already selling put options that were 20 or 25% out of the money, right? So 12% didn't hurt me. And I made all my premium in March 2020. Whereas if I had sold something towards the end of February when nobody could see how bad this is going to get, this would have made me nervous and sweating throughout March. So this is why I like the very short expiration. So you average over more stuff. And then I should also say that, again, on weekdays, it doesn't matter to me if I have to do this at 6:30 in the morning. Sometimes when I go on a hike, and if it's a short enough hike, I'll be back for my close. Sometimes I can trade while I'm hiking. Sometimes I can trade while I'm skiing. The big ski resorts around Mount Hood, they are also very well covered with LTE and 5G. So I can do it on my phone while I'm sitting on the lift ride. And then if everything else fails, right, if I'm on a cruise ship close to the Nordkapp in Norway and maybe I don't have very good reception, then I can outsource it to a friend of mine. So he has access to my account and he can trade my options. And I will do it for him if he's traveling. So I have never felt the constraint that the daily trading is messing with my early retirement. It's almost like doing this every morning and afternoon is almost like, watching sports, and you are rooting for the S&P. Come on, you can do it. And so it gives you a little bit of excitement and intellectual stimulus. So I don't mind it. If I get a little bit older, maybe in 10 years, I don't want to do it anymore, but maybe then I'll outsource it to somebody else. But so far I can still do it. I don't consider it day trading where you sit in front of the screen for the entire 6.5 hours and you're looking for patterns. So I do my stuff really very stoically and very, very much the same thing every morning. But of course, every morning is slightly different, right? So you have to look at, where do I think is the juiciest strike? And I haven't quite automated it. Maybe I'm going to write some kind of an API because Interactive Brokers is very good at supporting that. And I just write some Python code and let that run automatically. I don't quite trust the computer yet to completely outsource that. But maybe in 5 to 10 years, I will be at that point.
Can I selfishly ask, how are you choosing strike? Are you using percent change? Are you using delta? How are you choosing your strikes?
Yeah, delta. I sometimes it's just the premium. If I think the premium is far enough out of the money, hey, I'll do at that premium. Sometimes I will check what was the worst one-day move over the last X days, and then I will go to that and maybe a little bit of a cushion. But yeah, I have a little bit of my proprietary little code where I look at where does it look the most rewarding. But it's obviously it's part art and part science.
Right.
So there's still some discretion for me. And some of the best trading days are actually, and I don't know if you have ever noticed this, but when there are actually 6 expirations in the week, right, which is the third Friday of the month, when the S&P 500 options have an AM expiration and a PM expiration on Friday. And for some reason, between Thursday PM and Friday AM, people are willing to pay for put option protection for just overnight. There's usually nothing going on overnight on that Friday. It's no payroll employment release. There's no CPI release. And people are paying higher insurance than the last week from Thursday PM to Friday PM. And now they're paying you the same rate or more for a put option for just overnight from Thursday PM to Friday AM. And so I go a little bit crazy for the Thursday to Friday morning expiration. So I do a lot more leverage that day than I would normally do. But yeah, so that's so for special situations like that, obviously, then there's some other special situations, right? There would be FOMC meetings, right? So around the FOMC meeting, there's some extra volatility, very rich premiums. Doesn't mean that you should always take it, so don't get too greedy around that time. Maybe just take your 20 cents premium, 25 cent premium, and then 25 cents times 100, obviously. So it's a $25 premium, and it's all good overnight. And so don't get too greedy because who knows? Maybe they surprise FOMC date. But yeah, so it's not that easy to completely formalize that and automate it into a robot. So which is good. So I'm not quite yet so so out of fashion that somebody could just replace me with a robot. So there's still something I'm still useful for something.
Big Earn, what would you name this robot if you had the rights to it?
Small Earn.
Small.
Little
Nice.
Earn.
Gentlemen, you're both very smart. You're both credible. I know you both personally, so I can vouch for your integrity. So this is the question I want to ask, and many people are probably wondering. Looking back, is this a net positive for you? Many times, even so-called experts get on and tout a particular strategy, but won't share their numbers or won't admit that they actually maybe even ultimately lost as compared to other opportunities. How has options generally been for you and your experience trading them?
So since 2018, when I retired, my strategy made me, I think the last time I checked, is about $650,000. So in 6 years. So that's pretty decent. And this is out of selling about $1 million worth of premium. So I made $650,000. So out of every dollar of premium I sold, I actually got to keep 65 cents, which, by the way, also means that in between, there were basically, I had $350,000 worth of losses. So it's obviously, luckily, sprinkled into small enough chunks that I slept pretty well during retirement. But yeah, I mean, so this is really worthwhile in the sense that this option trading strategy made me enough money that I didn't really have to withdraw any of my principal. And so this is, in my view, this is almost the solution to sequence of return risk, right? So you get extra premium. And by the way, there's some other people who say, well, why don't you just buy higher dividend stocks? Well, that's not working, right? Higher dividend stocks, the dividends are not for free, right? Everything else equal, higher dividends will basically keep the total return the same as it would otherwise be. And it would decrease your price return if your dividends are higher. But this is, and this is what I said in the beginning, this is purely on top of the portfolio that I already have, right? I mean, I could just shut down the option trading. I would still have my portfolio. It has equity index funds, it has preferred shares, it has some bonds. So this is purely on top of that S&P 500 index portfolio. And it made me enough money that I didn't really have to withdraw a lot of the other stuff. And by the way, if it ever stops working, I mean, I also have enough income from that preferred shares and equity index fund that also throws off quite a bit of dividend income. So I wouldn't need to withdraw much from any of the other accounts. So yeah, so from a sequence of return risk point of view, it gave me a lot of peace of mind, and it made sure that I didn't have to withdraw anything from my equity portfolio. As I said in the beginning, equity market since I retired in 2018 is up over 100%. So I didn't have that opportunity cost.
So to wrap that all up, since 2018, you've made $650,000 using your strategies.
This option trading strategy, yes.
Yeah. And Brad, how would you characterize and quantify your options trading performance?
I don't know exactly how much. I probably could have looked. I have no idea. But because my full disclosure or my caveat is I do a lot of the things that I do with money because I have a YouTube channel and I like to talk about it. And I don't really need to know the numbers because I'm pretty much an open book there. So anybody could always go find what they need to know. Mm-hmm. But I have no problem telling people that if I didn't have a YouTube channel, I would never be buying options. The only time I'd be buying options is to close ones that I had already sold. Because to close an option early before expiration, if I'm the seller, to close it, I just buy it back. And you make the money on the difference. Hopefully you sold it for more than you buy it back, right? So, I mean, do I still sell options for YouTube content and to help people in my Discord communities and things like that, or to show examples of the good, the bad, and the ugly? Yes. But I'm doing that with almost like business type funds. I consider them expenses to the business or fees that I pay to keep that side business going. Mm-hmm. I have lost a lot of money. I've not made any money buying options. Like I said earlier, with the exception of that Black Swan event with AMC and GameStop, where I just got lucky. That was me hitting a number on the roulette table, and I was lucky enough to walk away. But I can say, even numbers aside, that if I did not have a YouTube channel and I did not teach people and I didn't have a Discord community or anything, I closed all the computers tomorrow, I'm still going to be selling options on a regular basis for the foreseeable future. I have found a spot, and that's kind of what we've talked about over and over again today. I found a spot where I know the risks. I know how to mitigate those risks. And as long as I avoid the greed that comes along with trying to get rich quick, I think this is very, very sustainable for me. And I just, as a general rule of thumb, I tell people that I like to shoot for about 1% of my portfolio every single month. Sometimes it's 3, sometimes it's -2. But if I can, at the end of the year, say that I increased my portfolio by just 12% on the low end and maybe up to 24% on the high end, that's been a pretty sustainable calculation for me over the last 7 years or so.
So just as a follow-up, so in Brad's defense, right, it's harder for him to do a complete and proper profit assignment to the options, right? Because imagine you have an Apple stock, trades at $200, you sell an option at $220, and then the stock goes up to $240, and then how much? And you basically lose out on that additional gain of 20. And well, how much have you made from the option? Well, in some way, the option cost you money, because you didn't make the profit all the way to 240, because if you just held on to the Apple stock, you have that opportunity cost. On the other hand, well, in some way, you always make money with the call because, well, you get the premium for it. But of course, you could cause a loss if something is assigned. How to get that out? You almost have to be a forensic accountant to do that. So in that sense, my strategy is a little bit easier in that sense, even though it's more complicated in some other ways. I can just, I can basically get an account statement from Interactive Brokers. I download that as a CSV file, and then I look at everything that's related to SPX. And so I can separate out my base portfolio, which has my index funds and the other shares, and everything options related. So it's a little bit easier for me to do a proper profit assignment and allocation. And one word of warning because of that is, I mean, be careful if YouTubers promise you some outlandish return targets, because of this difficulty. How much is really from your option trading? How much is from your stock picking? How much is from market timing? How much is from the underlying stocks themselves? How much is, well, the S&P 500 also went up by 20% most years, except for the 1 year when we had the bear market recently. So how much is really due to the option trading? Sometimes it's hard to disentangle there. So
yeah, you're absolutely 100% correct. Like if I go on my portfolio that I used to trade options and click year to date, it might say 40%. Well, I can promise you that 40% wasn't all from trading options, because I am holding 10 stocks in the S&P 500.
And the superstars potentially, right? So,
exactly. Like what NVIDIA has done to my portfolio this year, just holding 100 shares of NVIDIA, the options that I've sold against NVIDIA, I can't hold a candle to it. And yeah, then those potential losses upon assignment, I know how to do this now for years, so I know how to kind of avoid assignment. I haven't gone to expiration in a very long time. I usually roll options that are going against me. I can roll that expiration out, but that's another skill set. But yeah, no, when you are holding shares and just doing calls, it just gets I would have to pull, and trust me, the YouTube community has wanted me to pull every single trade out and take the net of the sell and the buy to close. And I did it for years, but now it's just like, hey man, you can either trust me,
I have it.
You go back and look, or you can not. There's nothing.
I have it this year. This year I have, I think, close to 9,000 contracts that I traded. I have I have the start, the finish, what date, what time I traded it, what the S&P was at that time. It's actually, so the record keeping takes me more time than the actual trading.
Yeah,
so I'm done trading at 6:32. At 6:35, I'm done with the Excel sheet. So yeah, so it's
for you.
But it's easier for me, because naked puts and calls easier in that sense. Yeah.
Okay. I have some logistical questions regarding
your
options.
hair hasn't set on fire yet, David.
What kinds of accounts can you or can you not trade options in? Can you do it in a Roth? And you already mentioned, Brad, that you did yours in your Roth. Mm-hmm. You have a normal brokerage with Interactive Brokers. I think I understood that to be correct, Karsten. Mm-hmm. can you do this in a 401k? Can you do it in a self-directed? Like, what are you limited to options as far as the accounts?
The broker, there's different brokers are going to require you to have certain levels of options and education. And for example, like you go on Robinhood, they'll let my dog trade options if you want, where if you go up to more reputable brokers, they're going to do a little bit more due diligence on you to make sure you know what you're doing. I can only speak for the accounts that I've traded in. I've traded in personal brokerages, solo 401ks, my Roth IRA, my traditional IRA. And it's pretty much from what I've seen, anything that has options available, like we mentioned earlier that there's some funds that just don't have options available. The market makers don't make them. So you can't trade. It's more what assets can you trade options with, not necessarily the limitations from the broker.
Yeah. So my specific strategy, naked puts, naked calls, only in a taxable account. So it cannot be done in a retirement. But in a retirement account, obviously you can do covered calls. So that you have to apply, quote unquote, and answer some questions about your option trading experience. And I always wondered, what if you answer, I have zero experience, I want to learn it? Will they give it to you? There's a chance, it's kind of a circular argument.
I'll let you know.
You need experience to actually trade it, but how do you gain your experience in the beginning? I always claimed, obviously I did it through my job. I had experience in options trading. So, but anyway, so my specific strategy, I do that at Interactive Brokers in a regular taxable trading account, and it requires portfolio margin, which is the highest level of margin account that you can have. I think Reg T is not enough. It would be very cumbersome. You couldn't do it with the type of leverage that I require sometimes in a Reg T account. It has to be portfolio margin. So I think the minimum account size for that is either 110,000 or 120,000. So,
and then as we also mentioned, there's different types of option strategies. For example, spreads.
Right.
So your broker might require you to have a little bit more experience where you might have level 1 option clearance where you can sell covered calls and cash secure puts, but you can't sell a spread, which is a horse of a completely different color and things like that. So it really depends. It's broker to broker and you got to do your research. But you talk to rules of thumb. I think general rules of thumb are know how to exit the position. So how to get out. If you're selling options, you're going to have to know how to buy to close that option or roll that option. And also just do it with a stock that you happen to have to hold it on the put side. Share price goes really far down. You don't mind bag holding it, or, take Karsten's advice and don't stock pick. But I like to take low volatile stocks when I began. I think the first stock I ever traded with was Wells Fargo. That didn't end up very well either. I bag held that for a long time. But people love the dividend stocks because they kind of trade kind of flat, not a ton of volatility. Don't need to worry about getting assigned. You can kind of go far out of the money. And I've seen people have success with it that way. But with dividend stocks, like I said, there's just another area of risk and that you have to take on. But the index route or the S&P 500 stocks, I think it's much better to wait a couple years and save up 20 grand and get 100 shares of Apple than to say, I need to start trading options tomorrow and I'm going to do it with a crappy stock like Peloton, and then you lose your money.
Or do it with the index. So SPY index, it's a start.
Karsten, it seems like you're probably a favorite with your accountant since you have these nice Excel spreadsheets all ready to go within seconds of a trade. And maybe not so much you, Brad, but how are profits from options trades taxed?
Oh, I'm not a CPA, but I will say this. As far as I know, they are taxed as short-term capital gains. And a common misconception, or at least a micromanaging that I see people do, is they worry about the taxes on one particular trade. You have an entire year of trades. You are going to sell and collect premium, and you're going to buy to close, and you're going to give some premium back to do so. And you are going to pay short-term capital gains on the net of selling to open and collecting premium and the buy to close, giving away premium.
Yeah. So my tax time is very easy because I can compress 9,000 lines of trading in my Excel spreadsheet because these are special contracts. They're called Section 1256 contracts. I'm going to get only one number reported on a tax form at Interactive Brokers, and I put that into IRS form 6781. And then all my net profits are considered 60% long-term and 40% short-term profits. So that's one nice thing about anything that falls under IRS Section 1256. These would be the SPX options on the CBOE, would be options on futures contracts, also futures themselves, right? If it's index futures, you make any profits there, that's also considered 60/40. And then any kind of option on a broad index or any kind of option on commodities, whether it's oil, gas, pig halves, or wheat or corn, all of those options are also considered Section 1256 contracts. So tax time is actually relatively easy for me. Even though, I mean, obviously today now we have all sorts of ways, you download as a CSV sheet all of your tax statement, and then it reads it into Tax Act or TurboTax. It's not the end of the world if you have to itemize all of these trades. But nice thing is, for all these naked puts and calls that I sell, the tax time is relatively simple because all the IRS cares about is the net at the end of the year, and that's reported already at IB.
All right, gentlemen. Now, Brad, you have a Discord and you have a YouTube that talks about options.
I do.
You did not ask me to do this, but would you recommend someone like me who might be interested in just learning and maybe dabble as a little hobby trade, join your Discord? Or are there other places like your Discord where a person could get a responsible education for options trading?
Yeah, I always tell people the value of my Discord is not me. The value of my Discord is the community inside my Discord. Everything that happens inside my Discord is on my YouTube channel for free. So there's no like secret sauce handshake type education going on in my Discord. Generally, people will join my Discord because they've watched a couple videos and they just want access to me to ask me direct questions in real time, but also be able to talk to other people that are like-minded and trying to do the same thing at all different levels. You can come into my Discord and have somebody that is literally can ask a question that they could never Google the right type of, they wouldn't even know what to Google, but they can post a screenshot and they can ask a valuable question and get immediate feedback from people in real time doing the exact same thing as them. That's really the value of the Discord. It's not the education piece per se. It's the access to people and resources. As far as like learning, you can go and type in on YouTube, Brad Finn covered call, and you're going to get 25 videos. I mean, I got to be ranked pretty high in search for covered calls and cash secured puts and every other options trading thing out there. So you can get that education and leave a comment, and I'll generally get back to you because I'm that type of guy. But I don't think that anybody needs to take a course. I don't think that anybody needs to be in a Discord. I think that you can get, just like I did, a lot of this information just by going onto YouTube or reading a couple books, but being able to ask questions. And I think that's really that's what the YouTube does. It just allows you to, quote, Google the guy that you learned from and get access to them directly, because even emails are slightly antiquated. I get emails. I very rarely respond to them, but if somebody's going to pay me $5 a month to have access to me, I'm going to give them that respect, and they're going to get an answer from me immediately. And sometimes I can't answer it. Like, I'm not on Interactive Brokers, but inside my Discord community, I have a chat that's dedicated to all different brokers. So somebody can be, hey, I'm trying to close a cash secure put on Interactive Brokers. Can somebody help me out? And within minutes, somebody's on there like, yeah, go to the top right of the screen, click that cog, the third thing down, click that. That's really what the value of the Discord is, not so much the education.
Karsten, you learned to do options trading at your job, I believe, more than a decade ago. Did you do any additional training, or is it just all real life experiences?
That's life experience. I mean, funny thing is, I wasn't on the trading floor, right? But I knew about option trading through the research side. So we would develop signals that will be sent to the trading floor. So I knew what options are, and so in that sense, I had that exposure and experience, and that's how So when somebody asks you want to open an account, what's your option trading experience? Well, I have this many years of option trading experience. So that's how that came about. No, but I mean, the option trading that I'm doing today, that is pretty much all self-taught.
Well, it's very, very impressive. Karsten and Brad, thank you both so much for sharing your expertise and breaking down the world of options trading. You've helped paint a much clearer picture for me, and I think I will probably at least research it some more. And Brad, I'll probably get into your Discord at some point to check it out. And now we all can decide if options trading fits into our own financial independence journey. I appreciate your time and guidance and look forward to our next chat.
Right on, man. Pleasure's been mine. Thank you so much, man. It's been a good time, good chat. And I learned something too. So thank you so much, Karsten.
Yeah, same here. Thanks for the invite.
And thank you all for watching and listening.